What's going on, guys? Welcome back to the channel. In this video here, we're going to be doing a stock analysis on Netflix. So I'm going to just pull this up in the stock research tool and take a look at this company. Their earnings came out a few days ago. They've been making headlines. If you've been living under a rock, they've lost 200,000 subscribers when they promised 1 million more. And as you can see here in these price drops, look at that, guys. We're sitting at $215 a share at the time of recording this video, and I'm very excited. I love when news like this comes out. I'm not a huge person. I'm not a huge watcher of the news, so when I see prices drop like this and I get like little tidbits in my ear of, oh, this is what happened, and the company, let's say it lost subscribers or whatever, and I get excited because I want to see, maybe it's worth picking up shares. Now, granted, this is a subscription-based business, so obviously I'm going to approach this with some caution. Looking at this company here, we're going through the financial evaluations. We're ranking this company a 6. So let's go through these 10 categories and figure out what they're doing properly. So off the top here, with a PE 5-year average, we are sitting at 107.51. This is absolutely horrendous. We want to see this number underneath 22.5. Now, if we just cross-reference to our company metrics, our trailing 12 months category, we are sitting at 1909, so that is an improvement. However, this number is still extremely high, so we're marking that down as a 0. Current ratio, we're sitting at 1.05. Now, what we want to see is this number to be at 1.5 or higher. The reason we want that is because we want to make sure they're able to cover all of their liabilities. Now, a 1-to-1 ratio is okay, but that 0.5 gives us that additional margin of safety, which we need in a business like this. Now, return on equity, they're going to get a point from us over here with a 24.12%. We want this over to 15%, folks, and we have that with Netflix, which is looking really good. EPS growth, massive growth over the last 5 years. And just to compare in our company metrics category, we currently in our trailing 12 months, we're sitting at 11.29, and our average EPS being reported is 5.23. So that is phenomenal that we are crushing those numbers. Our debt to equity, guys, that is an extremely high number. This is 92.71, and if you know me, I want this number to be under 50%. That means that the company has, they're growing the business through equity and not through debt, and just shows how much leverage or how much of a stronghold the creditors have on the business. So sitting at 92.71, it's not healthy, folks. That is a little bit rough for Netflix here. Jumping into share dilution, the company is slightly diluting you folks at 0.76 increase in shares over the last 5 years. Now, we want this number to stay the same, ideally, but even better than that is decreasing the amount of shares outstanding. Now, granted, look, this company it's such a popular business, and like you scroll back to 2017, and this company's just been on the up. Got to a high of $700, guys, in the last 52 weeks. So that's crazy, and then it's just been dropping down by considerable amounts. So it makes sense. The company's going to be issuing out more shares. People like the stock. People are going to buy it. It's one of the FANG stocks, folks. It's going to get a 0 from us over here because we want to see, as I said, the number staying the same or decreasing. So where they're doing well, though, is the net income is growing. The 5-year free cash flow is growing. The return on invested capital it's over 10%. And the revenue growth is also growing at a considerable amount, being at 27.59. It is a $95 billion company. Wow. I mean, this huge sell-off from $700 a share really took a hit on them. But these are some solid numbers and some solid growth rates. Comparing that to our, actually, no, let's look at our free cash flow, because even though it's increasing, we are still in the negatives, guys. We have negative free cash flow, but now we're still in the negatives, but we're up. We're not as negative. And net income sitting at $5.0 billion. Revenue is $30 billion. Okay. And our return on invested capital trailing 12 months is actually higher than our 5-year average. That's a great number to see, folks. We want this number to be 10% or higher, and we have that. Allman Z-score is sitting at 3.65, and Piotrowski score is sitting at 5. Now, this Allman Z-score sitting at 3.65 is decent. That just means that they're safe from bankruptcy. However, they are a tech industry with no actual tangible products. However, I can't really say that because they are a film production company and they have their own content. So there's a lot of other tangible assets attached to it. So I retract what I said. So this is actually a fairly decent number to see. Piotrowski score, however, we want this to be between 7 and 9. 9 being the highest score that we can possibly get. 5 is a very mediocre score. To be honest, I would have just... I'm not too happy. Based off what I'm seeing here, folks, just scanning this initially from our financial valuations and how they compare to our company metrics, it's a mixed bag. I think it truly is a 6 because there's a lot of things that the company's doing well. However, this debt to equity ratio is extremely high. I don't like that. Now, but the return on equity is decent. It's actually really good. They're slightly diluting you. A very high PE ratio, mediocre current ratio. Yeah, you know what? It is about a 6 out of 10. To be honest, I would just skip Netflix altogether. But I'm curious. I am very curious because when I hear news, as I said, that the price is just sharply decreases, this might be an opportunity to buy into the business. However, I do think that they are losing ground. I think Netflix overall, because there's so many other competitors, I feel like they feel like they were pretty much the kings of this whole streaming service. But now they're competing against Paramount Plus, Amazon Prime Video, and you got Disney Plus, which stripped them away of all their Disney titles like The Punisher, Daredevil. The one thing that kind of strikes me with Netflix is that they just pump out content. They just keep pumping out content and just hope that one of those things hit. Where I find that, let's say with HBO or with Amazon Prime Video, it's more curated. There's a lot more, I guess, thought into what's being put out. I mean, I can't remember the last time I've actually watched Netflix, like a Netflix show. Actually, you know what? Squid Games. And that came out a few several months ago. But there hasn't been anything that's grabbing my attention. But with Amazon Prime, like you have shows like The Boys, you have shows like Invincible, like totally different. But that's just my interpretation of what's kind of going on. I just feel like there's a fewer selection on Amazon Prime Video, and people don't have as much analysis paralysis. And you probably, if you have a Netflix subscription, you know what I'm talking about. There's so many things to watch, but you have no idea what to watch. That's exactly it. With that in mind, folks, I'm going to jump into a price analysis of this business and try to determine a fair price to pay for Netflix. Now, if you are enjoying the video so far, please consider liking and subscribing. You can find those buttons just down here. You can find them down here, and I would much appreciate that. If it helps out the channel a lot, helps out with the YouTube algorithm, makes me feel warm and fuzzy inside. So let's jump into a price analysis and see what we're dealing with Netflix and see what a fair price to pay would be. So looking at these numbers here, 215 current price, some decent revenue numbers, profit margin numbers, free cash flow is a little bit of a mess. Same thing with our price to free cash. Oh my god, that's absolutely horrendous. And PE ratio at 19.09 at the trailing 12 months. Okay. This is gonna be fun to play with. I'm gonna fill out these boxes. And we'll touch base in just a quick second, and I'll let you know why I filled them out the way I did, and yeah, we'll discuss it. All right, folks, so I filled out these boxes here, and I'm going to explain why I put the numbers in the way I did. Now, with our revenue growth, you know, I'm going to change this a little bit because I'm being somewhat lenient. I believe that the company can still grow. I just don't think it's going to be growing as much. Now, my conservative estimates are extremely conservative based off the premise that they're able to reclaim their subscribers, but they might be growing at a slower rate due to the competition. My aggressive category is they turn it around and they start releasing absolute bangers, and they're able to capture everybody like instantaneously. Now, with revenue growth, I've chopped it pretty much in half from our 5-year number. Well, we're almost sitting at 27%, close to that 30 number, and we're close to 26% and our 10-year number. I think it would make sense to, you know what? I feel like I have to go 13. I feel like this has to be 13 just because they've been losing subscribers over the last little while. So I'm wondering if that's going to continue and if they're going to if their growth is going to sharply decrease over time. So now, with a moderate, just to accentuate what's going on, a little bit more lenient, and obviously our aggressive category is the most lenient of them all. Profit margin, I think they're going to be able to stick within the same profit margin. Now, free cash flow margin was a very difficult category to fill because we've been sitting in the negatives. Now, I feel like it would make sense to put this at 0, but I want to put this at 1% to try to give them the benefit of the doubt. And then once I get my, I guess, return, or what the average calculation is over here, I want to play around with that 0 number and see what's going on. But I feel like 1% would be ideal. And then 4 and 6, this is the absolute wish list. I don't think this is ever going to happen in the next little while, given the current state of the company. Now, price of free cash flow, I'm also speculating, but I'm putting this at a very low number of 4, 10 for our moderate, and then 18 on the high side. This is some speculation here, folks. I don't think these numbers make sense to a certain degree, but this is a wish list for this company. So for PE ratio, I'm going to stick at 19 being our highest, just based off the trailing 12-month numbers. But at now, 10 years from now, let's see. When did this company go public? That's what I want to know. 2013. Okay. So yeah, I feel like it should come down in price as it becomes a much larger business, and as well with all the other streaming companies that are pretty much competing with it. I don't see this ever. There's no way to justify a high PE ratio like this. There's no way. So it has to come down, and I believe 15 is probably, it's conservative enough that at least kind of gives them some wiggle room. You know what? How about this? I'm gonna do 16, just because I like Netflix a little bit. Not much. I'll do 17.5 for the PE ratio on the moderate side. Then we'll put our desired return in, and that'll be 13%. So, based off the premonition of our moderate and aggressive categories, it's a buy all day. We're sitting. Sorry, let me uncover my big head. Sitting at $253 an average calculation based off these metrics here. Green across the board on an aggressive category. Now, moderate is sitting at $239, and our conservative estimate is sitting at a low price point of $81.97. Here's the thing, folks. I think that Netflix is in our conservative to moderate numbers. So if we just go back into those numbers right here, sitting at $81.97, this is assuming low revenue growth, somewhat lower profit margin, but a positive free cash flow margin, which we haven't seen yet. And then price of free cash flow sitting at 4, a very moderate PE of 16 with a desired return of 13%. I think that makes the most amount of sense, and that's the one that kind of speaks to me the most. Even with our DCF is just getting absolutely crushed here at $22 a share. Like, just to put that in perspective, folks. And with our moderate category sitting at $161 a share, it kind of makes sense that it might be in the slap dead center of being around 81. Because here's the thing, they're sitting at negative free cash flow. Like, just to pull up their cash flow statement, let's just look at that for a quick second. Guys, it's negative across the board with the exception of, what is that, 2020. 2020 was the positive year for free cash flow. Why? Well, everybody was inside at home watching Tiger King. That's the only reason why. Everybody was at home. Now people are kind of returning back to work. Pandemic's pretty much done. So what are people doing? Not watching Netflix as much. Or they're jumping ship. They're jumping ship and they're going to another streaming service. There's other streaming services out there that have a lot more better content. A lot more curated shows. There's a reason, and again, I was thinking about this the other day. I was thinking about HBO and how HBO still is relevant and how little they actually put out in content. Like, they put out Sopranos, Game of Thrones, Chernobyl. Now they're doing the Last of Us TV show that's currently being filmed, which I would love to be a part of that. see me as like a clicker or whatever. But here's the thing: they put out these shows every now and then, and it just sucks in an audience. They're not pumping out quantity of just shows like Netflix is. They pretty much approach it like, here are the shows. Here's this one show that we're gonna do. We're gonna crush it, suck you in for God knows how many episodes, and then have you craving more. Netflix, I think what's truly crushing them is that people binge their shows and then just drop the subscription. Because think about it. You want to watch a show. They just release all the episodes all at once. And then what? You watch it. You binge it. Okay, that's 8 hours done of 8 episodes. Cut the subscription or borrow someone's password, right? Hey, can I borrow your password to watch Squid Games? I'm going to binge it real quick and then afterwards give it back to you. You don't have to pay for that subscription. Your other friend doesn't seem to mind because, hey, I'm not, they might not be using it. So they're losing money left, right, and center because of just how they set up their content. It's tough to say. Right now, based off what I'm seeing here, guys, I'm avoiding Netflix. I'm avoiding Netflix. I mean, it just I like that the price is going down. I wanted to see sub 160. That would be nice. Hit that $100 price range, and maybe we can talk about something. But how it currently stands, I just can't justify these high numbers, especially dude, this is pure speculation. And if you believe these numbers here that I'm showing you here, folks, this is some wishful thinking. It's some wishful thinking. They're not the kings anymore. They're not the kings of streaming services anymore. There's a lot of other players on the market, and they're out for blood. They're out to try to take them out. So just be mindful with this one. If you're invested, it might be, if you truly believe they're going to make a comeback and reclaim subscribers and up the quality of their content, because I think that may just be the prime issue here, because there's just so much of it, then perhaps average down to this business. However, if you're looking to actually invest into this business, I can't justify based off these prices here. But remember, like everything, folks, you have to do your own due diligence, take a look at what's going on. But yeah, it's a no from me, dog. It's a no from me. I don't know why I said that. I apologize, but it's a no from me. If you like the video, hit the like button, hit the subscribe button. I'll see you in the next one. Thank you so much for watching.